Welcome to the CFA Society Emirates Investor Education Series. The topic for this video is core portfolio management. I just wanted to start this presentation with a quick description of who the target audience is for this presentation. And it's really individuals that are investing already or contemplating investing. And investing is really converting cash to another asset class. So here I have a graph from the World Wealth Report. This is published by Capgemini. And the reason why I wanted to show this is because, first of all, it shows different asset classes that people invest in. For example, equities, fixed income, real estate, cash and cash equivalents. And then we've got here this category of other alternative investments, which you can see typically is a fairly small percentage globally. And the reason why this is important, because if we look at North America, for example, we can see that the percentage invested in equities on average is over 30%, around 34%, where here in the Middle East and Africa, it's much lower. You can see it's about 19%. So the two things that come out of here is that equity investing in the MENA region is lower than other regions. And when we're talking about core portfolio management, we're typically talking about the traditional asset classes, which are equities, cash and cash equivalents, and fixed income. So we can see that equities is a lower percentage, and that is because in the Middle East and Africa, the stock markets are typically frontier markets and emerging markets. So the history is not as long, the size of the markets is not as big, so therefore the percentage of assets invested in equities is not as big. And so this presentation is really to give more information on core portfolio investing in equities, and not only in the GCC MENA region, but looking at a globally diversified portfolio. Okay, and we can see that real estate investing in the MENA region is higher than other regions. So here we can see the global average for 2015. There's North America, and we've got Asia Pacific, Japan, Europe, Latin America, and the Middle East. And I just wanted to start with this to show that depending on the audience, the background, the history, the knowledge is a little bit different. Okay. Some of you may be familiar with the term core satellite investing, and really what is that referring to? When the focus for our presentation today is on this core portfolio, and that's made up of the traditional asset classes of stocks, bonds, and cash. That's the core portfolio. When we refer to the satellite, we can look at non-traditional asset classes such as hedge funds, private equity, commodities like gold, real estate, in some types of insurances, currencies, and perhaps some structured products and derivatives. Okay, and finally, investments of passion. Investments of passion could be cars, stamps, musical instruments, jewelry, etc. But the focus for this presentation is the traditional core portfolio, which is stocks, bonds, and cash. On this slide, we're going to talk about strategic asset allocation. What is strategic asset allocation in this context? It's the mix between the stocks, the bonds, and the cash. What percentages we put into stocks, what percentages we put into bonds. And the asset allocation for an individual in their 30s that still has a long runway of working and saving and investing may be different than the asset allocation from someone in their 60s or 70s that wants to protect their wealth and not accumulate it. Okay, so asset allocation is the mix between stocks, bonds, and cash when we're talking about the core portfolio. So here's a quote from some quotes from Jack Bogle, a famous American investor, and it's with regards to simplicity. So stick to simplicity. Don't complicate the process. Basic investing is simple, a sensible asset allocation to stocks, bonds, and cash. Perhaps the most critical decision you face is getting the proper allocation of assets in your investment portfolio. Stocks are designed to provide growth of capital and growth of income through dividends, while bonds are for conservation of capital and current income. Once you get your balance right, then just hold tight, no matter how high a greedy stock market flies, nor how low a frightened market plunges. Change the allocation only as your investment profile changes. The paradox is that in these times of increasing complexity, simplicity underlies the best investment strategy. So the theme throughout this presentation is to Set up and manage a core portfolio of stocks, bonds, and cash does not need to be complicated. It can be fairly simple. The purpose of this slide is to back up the previous slide with some data, okay? Because the previous slide says that stocks are for growth of capital and income, bonds is to protect your capital. So where are we getting this data from? It's from the Ibbotson SBBI yearbook. So I just want to show you quickly that the Ibbotson SBBI yearbook is published annually, and now it's published by Wiley, and anyone can order this book. It costs £160 British or 177 euros for a hardcover book, and also you can buy an ebook, okay? This data is widely quoted when we're talking about historical returns to stocks, bonds, and T-bills, and it's U.S. data. We're looking at U.S. data because it's the largest and oldest market. So you can see that my slide is using up to 2012 data because I've been using these slides for a while and have not updated it to 2017. Nevertheless, the percentages haven't changed very much and the story is pretty much the same. So what we're looking at here is the growth of $1 from 1926 to 2012. So here 1926 we start with $1 and then we get to 2012. So if we start at the bottom here with just cash, if I had $1 say in 1999 and I put that in my cupboard, it would still just be worth $1 today. But we know that there's been inflation on a compounded annual rate of around 3% in the US, so that dollar won't buy me what it did in the past, okay? So if you want to protect your purchasing power, then you could convert your cash into a money market, which is instrument such as a T-bill, a treasury bill, and you can see that the compounded annual return is just above the rate of inflation. Next, we have the bonds. So as the previous slide said, preservation of capital, we are looking at government bonds in this case of giving a compounded annual return of close to 6%. So there is some growth in capital, but if your objective as an investor is to accumulate wealth, to grow your wealth, then that is why we look at investing in stocks, because we can see here that investing in small stocks, the compounded annual return has been close to 12% from 1926 to 2012, and for large stocks, it's close to 10%. And that's often why when people talk about investing in stocks, their kind of expected return is often around 10%, because it's referring back to the long-term historical average. So you can see that if I started with $1 in 1926, it's growing quite substantially to 2012 to approximately $3,500. And you can see small differences in percentages. That's the beauty of compounding. If it's invested in small stocks, then the growth of your capital is quite dramatic. The previous slide, we're looking at returns to T-bills, bonds, and stocks, but we cannot look at only returns. We also have to look at risk. So this slide is looking at risks in investing and the definition of risk. Greater variability in market prices and cash flows can be thought of as commensurate with increased risk, because an investor owning a risky asset with a highly variable price pattern faces having to sell it for a more unpredictable price than a less risky asset. So the assumption that variability in asset returns represents risk, and that premiums over what could be earned on a riskless investment represent the price of risk, is the foundation for modern finance theory. It should be stressed that when analyzing investments, returns provide us with only one half the information we need. Information on the risk characteristics of investments are equally important. So we measure risk by calculating variance and standard deviation. So on this slide, we have the same return information from the Ibbotson data, 1926 to 2012. So recall inflation was at 3%. The compounded annual return on treasury bills was 3.6%. Bonds, treasury bonds and corporate bonds, close to 6%. And then we moved to the stocks, large capitalization stocks and small cap stocks, 10% up to 12%, okay? So the return data was what was plotted on the previous graph, but what I've added to this slide now is the risk. and risk as measured by standard deviation, which is the square root of variance. Okay, so we can see the higher the return is the higher the risk. And so often you'll be familiar with a graph that has return on the y-axis and will have risk as measured by standard deviation on the x-axis, and it'll be a graph like this. Okay, so for higher returns we expect higher risk, and that can be measured. Okay, it's easy to measure it. And so this slide is just confirming with some data that if you're seeking higher returns by investing in the stock market, then you need to expect higher variability in prices year on year, which is higher standard deviation. And so therefore, if you need to sell, if you have to sell when the market is at a lower level, then you're being exposed to more risk. On this slide, we're just going to continue with our discussion on the risk, and I'm using some information from the JP Morgan Guide to the Markets. And that's a publicly available document. If you just Google search JP Morgan Guide to the Markets, you'll find a PDF. And this graph is looking at the S&P 500, which is the stock market index for the US, okay, 500 of the largest companies. And so now, if we look at that Ibbotson data from 1926 to 2012 or 2017, we could see that large cap stocks in general on average had a nice growth rate, say close to 10%. But that ride is not smooth, okay? If we look at smaller time periods, we can see that there's considerable variability as measured by standard deviation. So this graph is a nice, sums that up by zeroing in. If we look in particular at the crisis, you may recall 2008, 2009, we're looking at the S&P 500 not on a calendar year, but from sort of the peak to the trough, we could see that the market was down by 57%. Well, what does that mean? Let's say you had $100,000 at this point. When you got to this point, when the market's down, and you're invested $100,000 in an index fund that's tracking the performance of the S&P 500, well, you'd be down to $43,000. Okay, so that's the issue: is that long-term, on average, stocks will provide you with growth, but in the shorter term, there's considerable variability. So if you're uncomfortable with your account having gone from 100,000 down to 43,000, then there's an issue with investing stocks. But if you understand trends and cycles, and your expectations are that if you hold on from this case, so you don't sell, because you only have an unrealized loss at this case. It's not realized unless you sell, unless you panic and sell. But if you hold on, then you can see that your account will be back to the 100,000 and plus in the longer term. Okay, so that's the consideration with investing in stocks, is the short-term variability and the long-term horizons. They say that a picture is worth 1,000 words, so I'm just staying with this topic of variability. And what this graph is looking at is that the S&P 500 annual returns. So this is calendar years, and this is from 1970 to 2016, and includes dividends. And where am I getting the data from for this, for the graph? It's from New York University, Damodaran. He has some excellent data on the returns of stocks, bonds, and T-bills as well, which is publicly available, and that's the link to it. So this is looking at annual returns of the S&P 500. So again, you can see that yearly, there's considerable variability in the annual returns of the S&P 500. And what's interesting to note is, from 25 to 30% of the time, we're going to get calendar years that are negative. So again, if you're invested in a index replicating exchange traded fund ETF in the S&P 500, then about a third of the time, at the end of the calendar year, your balance is going to be less. But we know long-term on average, there are more positive returns than negative returns. So long-term on average, your balance will grow. But in the short term, there's considerable variability. And so we measure that. We can measure the variance, and then square root of the variance is standard deviation, and that's how we're measuring risk. And this, again, picture's worth 1,000 words. You can see considerable variability in the annual returns of the S&P 500. So this slide is taking the exact same data from the previous slide, but instead of looking at the annual returns, what we've done is we've created a histogram. And how do we create a histogram? We take the data, we sort it from the most negative return to the most positive return. And then we create some categories. So 0 to 10% positive return, 10 to 20, 20 to 30, 30 to 40, etc. And on the negative side, 0 to negative 10, negative 10 to negative 20, negative 20, negative 30. And then we count how many times the returns fell into those categories. So we can see, starting at the the crisis 2008, which was the worst return on the calendar year, it fell between negative 30 to negative 40%. Okay, so that happened once. That was in 2008. But what we can see here is we're looking for the most frequent returns. And we can see here, most frequently, the returns have been from 0 to 10%, 10 to 20. Okay, 0 to 10%, we can see that was 11 years, and 10 to 20% was 12 years. And again, that's why when this relates to people's expectations of investing in stocks, that they're getting somewhere 10% or 10% plus. So I'm using some data again from the JP Morgan Guide to the Markets, and what this graph is showing us is that the longer your time horizon, the less chance of a loss if you're investing in stocks. Okay, if you have a very short-term time horizon of 1 year, you're not going to put all your eggs into one stock basket, because you can see that the variability of returns, negative 37% up to the 47%. And again, that's what we were graphing by looking at the annual returns of the S&P 500 and putting that into a histogram and counting the number of returns. But you can see, if you hold, this is at 5 years, 10 years, and you can see that actually in the past for the S&P 500, until the 2008 crisis, there was never, if you looked at a 10-year time horizon, so if you picked any date and went 10 years later, there was never a negative return. But with that 2008 crisis, that was the first time ever that gave us a 10-year negative return. Okay, but if you go out to 20 years, then you can see by investing in stocks, there is a 0% probability of having a negative return. So the longer your time horizon, the more allocation that you can put to stocks, with the greater comfort that you're not going to have a negative return. You're not going to be forced to sell when the market is low, and you'll experience a financial loss. Okay, so the time horizon is key when we're considering investing in stocks relative to the risk. So this graph is looking at 6 asset allocation profiles. But what I've done here is I'm looking at the long-term positive expected returns, and this is the graph that most people are most familiar with, where we've got return on the y-axis and the risk on the x-axis. So as we go from here, a very secure portfolio, which is made up of mostly fixed income and cash, and a small portion to equities. What are we doing as we move to higher return, higher risk in terms of expected returns? Well, we're increasing the allocation to equities, and we're reducing the allocation to fixed income and cash. So we can see here at the two ends, the secure portfolio is mostly made up of fixed income and cash, and the aggressive growth portfolio is made up of mostly of equities. And again, I believe that I've provided the data to support why that is. And that's the graph that most people are familiar with. But what I've added to it is you can see here that it's the short-term negative returns in reality. And that's what the data is also showing to us, that on a 1-year time horizon, if you've got a very heavy allocation to stocks, then we can have on a calendar year negative return of negative 37%. A peak to trough we saw from that previous graph of 57%. And this is where for investors that are new, that haven't invested in stocks for a long, don't have a long history, this is the shock to the system, is that the short-term negative returns, and these are a reality. The data supports that, okay? So long-term positive expected returns, yes, stocks are going to provide that growth, but in the short term, you need to be able to accept and understand the volatility and the short-term negative returns. Okay, this graph is from a Barclays white paper. Again, it's publicly available. If you Google search average investor emotions, Barclays white paper, you'll find it. And what it's showing is that for the average investor, emotions can affect investment returns. And what it's showing is that for the average investor, The behavior is sometimes typically buy high and sell low, which is the exact opposite of what it should be, okay? But studies have shown that for the average investor, the markets are heating up. It creates optimism, excitement, exuberance, and people are buying into the market at very high levels. Then as the trends and cycles invariably happen, that when the market's going down, it leads to fear, depression, panic, capitulation, and many average investors sell, and that's exactly the wrong time. So I've been trying to show some slides that show you that trends and cycles are normal. Long-term on average, stocks provide good returns, but you have to hold on from here and ride it out. You'll get you'll get to back to where you were and then some over time. Okay. This slide has some nice quotes on risk from Benjamin Graham. He wrote a very famous book called The Intelligent Investor, which I recommend most people should read. And Benjamin Graham stated that every investor who owns common stocks must expect to see them fluctuate in value over the years. If you overestimate how well you really understand an investment or overstate your ability to ride out a temporary plunge in prices, it doesn't matter what you own or how the market does. So I put in bold here in green, ultimately financial risk resides not in what kinds of investments that you have, but what kind of investor you are. So if you're the average investor buying high and selling low, the risk is within yourself, okay? The market is a pendulum that swings between unsustainable optimism, which makes the stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. So that's the intelligent investor buys low and sells high, okay? Warren Buffett echoed this advice when he said, "Be fearful when others are greedy and greedy when others are fearful." That was in 2008. He said, "The sillier the market's behavior, the greater the opportunity for the business-like investor." Success comes from harnessing our emotions and understanding the things we can control and cannot control. What this graph is trying to show is the emotions of a passive investor. Now, what's a passive investor? It's an investor who is a buying and holding, not looking to time the market, not looking to pick individual securities, but investing in diversified ETF, exchange-traded funds, low-cost ETFs, and buying when they have disposable income, some savings and investing. So the market may be down at the time, they're buying in, the market might be a little bit higher, got some savings, still going to buy. So long-term on average, my average cost is going to come out somewhere in between. And so what this graph is showing is that the passive investor's emotions over time should be relatively relaxed, because we know that long-term on average, stocks provide us a good return. We know that short-term there is considerable variability, but if we stick to a disciplined program of buying when we have available cash and not paying attention to the short-term fluctuations, we'll remain relatively relaxed over time, okay? On this slide, I'm just looking at some quotes from Charles Ellis from his article, 3 Ways to Succeed as an Investor, and he outlines 3 approaches to investing. 1 is the intellectually difficult approach, 2 is the physically difficult approach, and 3 is the psychologically difficult approach. So the intellectually difficult investing is pursued by those who have a deep and profound understanding of the true nature of investing, see the future more clearly, and take long-term positions that turn out to be remarkably successful. So that would be someone in that category like Warren Buffett, okay, who's been very successful over the long term. The physically difficult approach, and I put this here in bold red, is that most of the crowd is deeply involved in the physically difficult way of beating the market. These are the day traders and these firms that encourage you to trade. In every way they can, they put enormous energy into trying to beat the market by outworking the competition. What they don't seem to recognize is that so is almost everybody else. So long-term on average, most funds don't beat their indexes, okay? Especially in the bigger, more efficient markets. In frontier markets, it's a little bit different. The physically difficult approach can lead to some returns that beat the market on average, okay? But being incapable of doing the intellectual difficult and reluctant about the physically difficult. That's for most people, most investors, I would say, that are saving and investing. Charles Ellis has said about the emotionally difficult approach of investing, and I put this in bold green. This straightforward, untiring approach is simply work out the long-term investment policy, the long-term asset allocation that we're talking about, that's truly right for you and your particular circumstances and is realistic given the history of the capital markets. Commit to it, and here's the emotionally difficult part: hold on. I just wanted to put this slide in to address the topic of rebalancing. Actually, if you do your research, you'll see that there's different theories and there's different recommendations with regards to rebalancing. But when we're talking about rebalancing, we know that stock market returns long-term on average might be going up, where the bonds are going up less. So if you set an initial asset allocation split between stocks and bonds, that allocation is not going to be the same a year later or 3 years later. So when we're talking about rebalancing, what that means is we would sell a portion, say stocks if they're high, and use the proceeds to buy back into bonds to restore the target allocation. Okay. Now, if the markets are down, then that's a buying opportunity to buy into stocks again to restore that allocation. And the rebalancer's emotions over time would be a disciplined approach. Okay. But again, if you do your research, you'll see that there is some discussion and debate over when to rebalance and how much to rebalance and the frequency of rebalancing. But I just want to make sure I put it in the slide to address the topic of rebalancing. I'm just going to finish up this portion of the presentation with some quotes from Warren Buffett. He often gives good advice in his annual reviews and reports. And so what he's saying here is you don't need to be an expert in order to achieve satisfactory investment returns. If you're not an expert, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fences. It's vital, however, that we recognize the perimeter of our circle of competence and stay well inside of it. Even then, we'll make some mistakes, but both with stocks and businesses. But they will not be the disasters that occur, for example, when a long rising market induces purchases that are based on anticipated price behavior and a desire to be where the action is. Okay, that's that buying high and selling low. Most investors, of course, have not made the study of business prospects a priority in their lives. If wise, they will conclude that they do not know enough about specific businesses to predict their future earning power. So that's saying that for most investors, it's not really possible to be a stock picker, to choose individual companies and predict their future earning power and determine that they're going to be good investments. There's good companies, but there's good stocks and there's good investments, and there's a difference. So what Warren Buffett says is that he has good news for these non-professional investors. The typical investor doesn't need this skill to be able to analyze individual stocks. In aggregate, American business has done wonderfully well over time and will continue to do so, though most assuredly in unpredictable fits and starts. In the 20th century, the Dow Jones Industrial Index advanced from 66 to 11,497, paying a rising stream of dividends to boot. And we could see that the Dow broke 20,000 for the first time last year. So the 21st century will witness further gains, almost certain to be substantial. So here's the key bit of advice, which I believe I've put into bold, is that the goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather to be own a cross-section of businesses that in aggregate are bound to do well. A low-cost S&P 500 index of fund will achieve this goal. So I've tried to provide the data on the history of the returns and the trends and cycles to back up these types of statements. It's good enough to say that, hey, you should buy a S&P 500 ETF, but if you don't understand the trends and cycles and the average long-term average returns, I think the data makes you more comfortable with what you're doing. So one last slide, finishing up with the quotes from Warren Buffett. So he says, that is the what of investing for the non-professional. The when is also important. The main danger is that the timid or beginning investor will enter the market at a time of extreme exuberance and then become disillusioned when paper losses occur. So this is referring to, you haven't invested in stocks before, you've you've got 100,000 dirhams or $100,000, and you're thinking that you're going to enter for the first time, but you're doing it when the markets are at 10-year highs, okay? And the risk is that if your initial timing is wrong, then in the short to medium term, it can have an impact over your emotions. You become disillusioned. So what he's saying is that the antidote to that kind of mistiming is for an investor to accumulate shares over a long period and never sell when the news is bad and stocks are well off their highs. So that's the buy and hold advice. Following those rules, the know-nothing investor who both diversifies and keeps his costs minimal is virtually certain to get satisfactory results. Indeed, the unsophisticated investor who is realistic about his shortcomings is likely to obtain better long-term results than the knowledgeable professional who is blind to even a single weakness. And I think that's the key thing. We can keep it simple, buy and hold, and you don't need to be intellectually difficult or physically difficult in terms of your investing. It's the emotionally difficult in buying and holding, okay? So it needs to be pointed out clearly that the preceding advice from Buffett comes under the category of do what I say, not what I do, because obviously he's taken the intellectually difficult approach and done very well. And that's the last slide for this section of the core portfolio investing. This next section of the presentation, we're just going to look at a case study, and we're going to look at the Abu Dhabi Investment Authority, the ADIA, and we're going to look at some extracts from their annual review. Okay, I'm just taking a screenshot here of the internet page. I just wanted to show you that the Abu Dhabi Investment Authority, their annual review is on their website. You go to the adia.ae, then click on Media and Resources, and then you'll see that they've got a review, and you can click here for their annual 2015 review, and that's where I'm using some data for the next series of slides. I wanted to use Abu Dhabi Investment Authority as a case study because, as you can see, they've got 40 years experience investing in global markets. So one of the arguments that I've made to individuals in the past, it doesn't matter whether you have $500 billion or 50,000, some of the disciplines and philosophies can be the same, okay? So first thing that we want to look at is the investment performance. These are the best and the brightest. They hire the best and the brightest from around the world. So how have they done? You can see that they show the 30-year returns, which are, they show 20 and 30-year annualized returns in US dollars. And we can see at the end of 2014, the 30-year return was 8.4%, the 20-year 7.4%. And a little bit lower at the end of 2015, the 30-year return 7.5%. So we can see the best and the brightest are getting about 7-8% on the 20 to 30-year returns, okay? So if you're expecting 15% returns through some basic core portfolio management, then that's where the expectations, the gap between expectations and reality may be a problem, okay? So that's the first thing that I wanted to point out, is that there's 40 years of experience investing in global markets. We've got 20 and 30-year histories, and we can see that see what their annualized returns are. Then the next thing to point out from the review is this section here. It says 60% of Abu Dhabi Investment Authority's assets are managed by external fund managers whose activities are subject to careful oversight by the internal Abu Dhabi Investment Authority teams, okay? But what is more important is that, so the 60% of the money is going outside to external managers, but 50% of their assets are invested in index replicating strategies. So what are index replicating strategies? These are the low-cost exchange-traded funds, ETFs, that replicate the performance of the S&P 500, for example, okay? This graph is from the Abu Dhabi Investment Authority annual review, and it's showing by asset class what their range is in terms of their percentages. And this is a very important slide because, as I said, it doesn't make a huge difference whether you've got 100,000 dirhams or $500 million. The asset allocation may not be remarkably different, okay? So you can see here the different asset classes. We've got developed equities, emerging market equities, and small cap equities. And you can see, for example, the emerging market equities, the range is from a 10% minimum to a 20% maximum, okay? So if we look at, these are the stocks here: developed market equities, emerging market equities, small market equities. If we look at the minimums, we can see that the minimum is 43% in stocks, okay, in terms of their overall asset allocation for the funds that they're investing. Then we move on here to the government bonds and credit, and that credit would refer to corporate bonds. We can see that the minimum there is 15%, okay? And then, of course, the Abu Dhabi Investment Authority is quite big, so they can move into alternative investments such as hedge funds, or there's real estate, private equity, infrastructure. You know, it's difficult for an individual investor to invest in infrastructure, but again, we can see these minimums and maximums are fairly low, and then it ends off with cash, okay? So in terms of the core portfolio, if we look at the minimums for stocks, bonds, and cash, it's not a heck of a lot different than an individual would have with regards to those asset classes. Throw in the real estate, and we're really close. What are we going to look at? Maybe a little bit different in terms of the alternative investments, hedge funds, and private equity, but again, relatively small portion of the overall Abu Dhabi Investment Authority portfolio. So again, can we invest with a similar asset allocation as the government does? Yeah, sure we can. We can replicate it. This slide is following up on the Abu Dhabi Investment Authority. The previous slide, we look at the asset allocation. So then based on those asset allocations to stocks, bonds, cash, alternative investment, well, this one is looking by geography. So where is the money flowing? So we can see that North America accounts for a minimum of 35%, a maximum of 50%. Emerging markets, minimum of 15%, maximum of 25%. Europe, a minimum of 20%, maximum of 35%. And developed Asia, a minimum of 10%, maximum of 20%. So we know the Abu Dhabi Investment Authority is making investments outside of the country, okay? So we've seen in the last two slides their asset allocation by asset class, and on this slide by geography. Okay, with this slide I wanted to look at in more detail the global framework for equity indexes. And because we saw in the Abu Dhabi Investment Authority review that 43% minimum of their assets are flowing into stocks, and that results in 35 to 50% minimum of their assets flowing to North America. And you can understand these numbers if you understand the makeup of the global indexes. So when we look at a stock market index, we can look at individual countries. So the United States, we've been looking at data from the S&P 500 or the Dow Jones Industrial Average. Here in the United Arab Emirates, we have three markets: the Dubai Financial Market, Abu Dhabi Market, and the NASDAQ Dubai. So we can look at investing in an individual company that's listed on an individual exchange. But what we can do is we can start to collect a number of countries and to put them into three major categories. And as I mentioned, the three major categories are developed markets, emerging markets, and frontier markets. So if we're looking at the frontier markets for the Middle East, Bahrain, Jordan, Kuwait, Lebanon, and Oman are considered by MSCI, the index provider, to be frontier markets, okay? And you can see under developed markets, emerging markets, and frontier markets, again, developed and emerging are broken up into the different markets in Americas, Europe and the Middle East, and Asia Pacific, okay? So if we look at so we've got the MSCI World Index. The MSCI World Index is made up of the developed markets. That's important to understand, that even though it says the world, it's not talking about the world, it's talking about the developed markets. Then you've got the MSCI Emerging Markets Index, which again is the emerging markets, and then they have an MSCI Frontier Markets Index, okay? So a level above the World Index and the Emerging Markets Index is the MSCI All Country World Index. Now, why is that important to understand this framework? Because there are low-cost index replicating instruments that will replicate different indexes. So as we saw, the S&P 500, we can buy low-cost ETFs, exchange-traded funds, that'll replicate the performance of the S&P 500. We can buy units in a MSCI World Index, okay, which will map the performance of the developed markets. The MSCI Emerging Markets Index is also investable through exchange-traded funds. At the All-Country World Index, not so much. Typically, investors like to split their investments between developed markets and emerging markets so that you can underweight and overweight in the short to medium term. Okay, so it's important to understand the global framework of the equity indexes. We start with the country, we categorize it whether it's a developed market, emerging market, or frontier market, and then we collect a series of countries and we can create indexes based on developed MSCI World Index, which was the developed markets, MSCI Emerging Markets Index, which is the emerging markets, and the frontier. But typically, large portions of money flow into the developed and emerging markets. Okay, on this slide, I'm just going to show you that we're going to look at an iShares, which is a BlackRock iShares. This is an exchange-traded fund, a mutual fund that's exchange-traded. And it is possible to invest in the MSCI All-Country World Index. So you can see here on the right-hand side, I did a cut and paste just to remind you that the MSCI All-Country World Index is made up of both the developed markets and the emerging markets, okay? And that's why I wanted to show you again, you can start to track the money, that if 43% minimum of the Abu Dhabi Investment Authority is in terms of equities and 35 to 50% is ending up in North America, it's because if you're investing in equities, you can see that the percentage in terms of the countries for the United States, the weighting, this would be based on market value. How do we calculate market value? It's the number of shares outstanding on the market times the market price, okay? So we can measure the size of a market in terms of market value, market capitalization. It's very easy. It's the number of shares in the market times the market price, okay? And that's why I said the US is the largest market. You can see if we look at the MSCI All-Country World Index, made up of all the developed markets and emerging markets, then the USA accounts for over 50%. Second is Japan, UK, Canada is number third, around 3%, okay? So again, it's fairly easy to look at the Abu Dhabi Investment Authority, look at their asset allocation in terms of asset class, then look at the geography and understand it by understanding the global indexes and what the weightings are by country in terms of the market values. So on this slide, just bringing it down from the All-Country World Index to the world, which I just want to remind you that that's the developed markets. So if we're looking at just in terms of developed markets, then you can see, of course, the share to the United States increases even more dramatically, but the rankings are still the same. United States, largest market in the world in terms of market value, followed by Japan, UK, and Canada, okay? So we can finish up this part of the presentation, show the Abu Dhabi Investment Authority as a model portfolio in terms of their asset allocation and geography, and just trying to understand a little bit better. So when we saw that 32 to 42% is invested in developed market equities, and we can see the US makes up the biggest share of the developed markets. So I just wanted to look quickly at the iShares S&P 500 ETF. So yes, and also the fact that they said that 50% of the Abu Dhabi Investment Authority assets are in index replicating. So the iShares S&P 500 ETF is an index replicating ETF. So we can see here, just taking a screenshot of the internet, it has a ticker symbol of IVV, so it's exchange traded. It has a very low cost, 0.04%, and that's giving you exposure to large established US companies, low cost, tax efficient access, okay? So it's tracking the index. So I just want to click here on the key facts, and we can see here, this is the important thing to understand, is that the net assets in this one fund that's in the US is 116 billion, okay? As at the 28th of June 2017. Now this is only one fund that is tracking, ETF that is tracking the S&P 500. If we look at the original S&P 500 tracker fund, we would look at the spiders, and you're going to see that it's also in the hundreds of billions. Okay, I've just moved over to take a quick screenshot to show that to not look at only the BlackRock iShares, but also to look at the State Street Global Advisors, the SPDR, which was like the original S&P 500 ETF. If you go to this website and you check their asset value, it's well over 230 billion, okay? So if you start to combine State Street Spiders plus the iShares S&P 500 ETF replicating, it's huge amounts of money. And again, so if we look at the Abu Dhabi Investment Authority, when they talk about 50% of their assets in index replicating, then you would expect that it's going to be a lot of it, a fair portion of it's going to be in iShares, S&P 500 or State Street Global Advisors, for example, potentially. What I want to show here that it is possible to invest in the MSCI All Country World Index. There is an ETF. iShares has an ETF, and that gives you an exposure to a broad range of international, developed, and emerging market companies. So if you just wanted one product, one ETF, it's access to the global stock market in a single fund. Now, is this popular? Not so much. If we go to the key facts here, you can see that the net assets is only 6.8 billion, which is considerably less when we look at compared to that's why I started with the S&P 500 ETFs that I showed you are absolutely huge. Most investors don't invest in the at the all country world index level, because we could see from the Abu Dhabi Investment Authority presentation that there's a range. There's a range for developed equities. There's a range for emerging market equities. And so if you want to adjust your investments between the two, developed markets and emerging markets, then you'd want to have two different index replicating funds so that you can adjust your minimums and maximums, do a little bit of underweighting or overweighting in the short to medium term. So recall a level below the All Country World Index was the Developed World Index and the Emerging Market Index. So recall MSCI All Country World Index was made up of the developed markets and the emerging markets. So, but again, if we want to overweight or underweight on the developed versus emerging markets, we would need two different funds, individual funds. So yes, it is possible to also invest in the iShares MSCI Developed World Index Fund. And if we look on the key facts on that, it is a little bit bigger. There's 635 million that's invested in that as of the 28th of June 2017. Okay. I just wanted to take a second here to show you exactly where I'm getting my data. I'm using the iShares website. I'm using the US website because it's the largest market. Okay, so I'm at the home page here of iShares by BlackRock. So if I wanted to find a fund, we've already looked at the MSCI All Country World Index, and then we looked at the MSCI Developed World Index. But as we know that the All Country World Index is made up of the developed and emerging markets. So if I click on here, find a fund, and click on emerging markets, it's going to bring up a list. Okay, so again, there's different asset classes and different strategies. But if I just scroll down here, you can see that for emerging markets, a total of 337 funds. So the ETF markets have really exploded over time. And I can see the top two here are the iShares Core MSCI Emerging Markets ETF or the iShares MSCI Emerging Markets ETF. So you can see both of these have got 32 billion in them. So if I just click on it again, the MSCI Emerging Markets, that's EEM, you're going to get all kinds of data in terms of the overview, its exposure to large and mid-sized companies in emerging markets. You're replicating the MSCI Emerging Markets Index. You see easy access to 800 plus emerging market stocks. Again, click on the key facts and you're going to see the net assets. Again, I'm not going through this all in this presentation, but if you look at terms of the performance, it's all here. The nice things about the iShares is that there's a lot of data that's easy to download and it's updated daily. Okay.